$143 million in net losses at SpaceX despite revenue nearly doubling.
For years, the most valuable private company on Earth operated in the dark. SpaceX built rockets, launched satellites, and stitched together a constellation in low orbit without ever opening its books to the public. That changed when the company stepped onto the stock market in a blockbuster debut. The initial public offering priced shares at $135, a number that signaled confidence in a future built on reusable rockets and a global internet network. Almost immediately, the narrative shifted. The company's first-ever quarterly filing as a public entity landed not as a victory lap, but as a shock. Revenue nearly doubled, yet spending exploded by a factor of 6. The bulk of that cash did not go to the launch pad or the Starlink factory. It poured into a new, power-hungry frontier, artificial intelligence. Investors who bought the story of a space company suddenly found themselves holding stock in a massive AI infrastructure bet. The result was a swift and punishing sell-off that wiped out the stock's early gains and dragged shares well below their initial offering price.
The numbers in the filing are stark. Quarterly revenue reached $7.8 billion, nearly double the figure from a year earlier, but total spending ballooned to $18.3 billion, more than 6 times the prior year's level. The company posted a net loss of $143 million for the 3 months ending in June. Over the first half of the year, the loss widened to $2 billion. The core space segment, the business of launching rockets, generated $962 million in revenue but still lost $542 million. The artificial intelligence division lost $1.2 billion on revenue of $2.5 billion. The single profitable unit is Starlink, which brought in $1.6 billion in the second quarter. Chief Financial Officer Brett Johnson told investors that the economics of the AI build-out are improving rapidly, with new capital deployments for compute paying back in less than 1 year. He also disclosed that the company signed another $6.7 billion in cloud computing contracts after the quarter close. Yet he signaled that AI spending would remain elevated. The market's verdict was immediate. Shares fell 9%, dropping to around $113, well below the $135 IPO price.
For an ordinary person watching this from the outside, the immediate impact lands in 2 places: the internet in their pocket and the price of everyday connectivity. Starlink is the engine that currently makes money, and it is the service beaming high-speed internet to rural homes, moving vehicles, and remote corners of the globe. If the company's enormous AI spending spree ever threatens the cash that Starlink generates, the cost or quality of that connection could shift. More broadly, this earnings report is a signal about the infrastructure that will power the next generation of digital tools. The chatbots, the smart assistants, the automated services that are creeping into phones and computers all require vast warehouses of computing power. When a company spends over $15 billion in a single quarter to build that capacity, it is a bet that those tools will become as essential as electricity. If the bet fails, the losses could ripple through investment funds and retirement accounts that now hold the stock. If it succeeds, the very nature of how a person accesses the internet could change, with a single company controlling both the pipes in the sky and the artificial brains on the ground.
The non-obvious insight buried in these numbers is a fundamental mismatch of time horizons. The market is pricing the stock based on a quarterly loss and a frightening burn rate. Management is pricing the strategy on a payback period of less than 1 year for new AI compute investments. Chief Financial Officer Brett Johnson is essentially arguing that the AI division is already beginning to fund its own expansion, a claim that stands in sharp contrast to the $1.2 billion quarterly loss the unit just posted. This is the same dynamic that has played out at Meta and Microsoft in recent days. Microsoft's stock surged after it reassured investors it could dial back chip purchases if demand softens. Meta's stock cracked because Mark Zuckerberg refused to provide visibility into future spending, prioritizing long-term capability over near-term monetization. SpaceX is aligning itself with the Meta side of that divide. Musk is asking investors to believe in a 10-gigawatt computing network that does not yet exist. Built inside data centers, he calls a trivial problem compared to reusable rockets. The why now of this story is that the public market is being forced to adjudicate a founder's multi-decade vision on a 90-day reporting cycle, and the first verdict is a 9% drop.
This earnings report sits inside a much wider transformation of how the world's largest technology companies allocate capital. For much of the past decade, Wall Street rewarded firms that funneled excess cash into stock buybacks. That playbook is now being shredded. Amazon has not repurchased a single share since the second quarter of 2022, choosing instead to pour capital into AI data centers and its own custom chips. Alphabet, Microsoft, and Meta are all committing record sums to AI infrastructure. The immediate winners have been the semiconductor companies supplying the chips. The hyperscalers building the data centers have seen their free cash flow crushed and their stock prices punished when the spending looks unchecked. SpaceX's debut as a public company arrives at the exact moment this tension is at its peak. The company is not just joining the public markets. It is joining a sector-wide, high-stakes experiment to determine whether the hundreds of billions of dollars flowing into artificial intelligence will generate a return before investor patience runs out.
That is the story. If this made it clearer, subscribe and turn on notifications so you never miss what happens next.